Looking for the best opportunities in Perth property? Get the local area expertise you need from Momentum Wealth, WA's trusted property investment consultants. Market insights, advice and representation from award-winning buyers agents and REWA Hall of Fame inductees. Visit Momentum Wealth's website at momentumwealth.com.au to organise your obligation-free consultation today.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi everyone, how are you going? Thanks for joining me on the podcast today as we navigate property and property investment in what is COVID, and whether or not, much like myself, you're probably over the whole COVID discussion. It is with us, it's going to be with us for many, many years to come, and this is the new watermark for how we're going to compare property moving forward. So hold on for the ride, get used to it, because it's going to dictate property markets in our lifetime and into generations moving forward. So much like you, I keep myself informed abreast of all the different information coming out from all different markets, trying to make some sense of where we're heading as a nation, where our economy is going, how we're going to rebound out of COVID, the life after COVID. And there's a whole bunch of different metrics and indicators I use for shaping my decision making and help shaping how I choose to approach this particular podcast, something we talk about. And by now I'm talking about those key headline numbers that you would hear or see on most news reports any given day. ANZ job announcements, for example, ANZ Roy Morgan consumer confidence ratings, Westpac Melbourne Institute also do a consumer confidence index. There's a whole bunch of numbers you can get around credit card spending, property sales up or down, auction clearance rates any given weekend, unemployment, what's happening there, et cetera, et cetera. We're running up to Melbourne Cup as we speak right now, and obviously there is another rate cut coming, so you only need to pick up any given paper at any given time to see what the economists are telling you about rates are going to go. So much like yourself, I also get quite confused about it, so I turn to and reach out to my network of people to try and make some sense of that. I'm just fortunate I get to do that as part of this Smart Property Investment Show live on air to you right across the nation, also globally, where we have a lot of listeners. So thank you. Today, I'm going to get stuck into that a little bit, but also have a look at what is actually happening in markets right across Australia right now, because if you listen to some quarters, you would have a very different perception or opinion towards what may be actually transpiring out there in property land. Joining me, Steve Waters, Director of Right Property Group. I've used and known Steve for many years to help build out the Smart Property Investment Portfolio, which we share on this show. You can go and check it out. Just click on Portfolio Update wherever you listen to this particular podcast. We're going to see what he's up to, what he's seeing out there. Ground truth, which is a term coined, he's probably going to claim it, which I've now made it my own. Stephen, ground truth, how's it going?
It's going well. There is a trademark around that expression.
Do you want to be known as Steve, verted commas, ground truth Waters? Is that your...
Look, I've had worse nicknames.
I bet you have.
I'll take that one.
It's probably not a bad thing, right? You know, but that's what you and your business partner, Victor Kumar, do, right? You sort of stand at the intersection between property data, information, economic data, all the other fundamental bits that you need to have as a good property investor with what is going on, and the human element, which makes good buying.
And the human element is a major portion of the pie, so to speak. I think a lot of people tend to become too analytic around data and forget that human component, because at the end of the day, we will, as humans, start to evolve around trends and follow trends, and then the data eventuates, not the other way around.
Yeah. So how is it out there in property land?
It's tight.
Yeah. What does tight mean? Most people are going to go, oh, people aren't spending money because they're a bit tight.
Look, it's amazing because we've seen that you mentioned earlier on the consumer confidence index, and that's something that we follow very closely. And it's on our charting, we've seen the infection rates ebb and flow, as does the index around consumer confidence, because that's also around mobility. What we've seen around the different states in terms of tightness is lack of stock on market, and it is a state-by-state scenario, with Melbourne being at the bottom end because of a lack of mobility. Their stock on market has been quite low, and their buyer tempo, whilst it's been lower than it was pre-COVID, it's certainly not non-existent. But then from the other end of the scale, you've got Brisbane and Perth and Sydney, which I would probably argue that the buyer tempo has reduced maybe 10%. But stock on market has reduced anywhere between 30 to 50%. So there's a naturally inbuilt floor, generally speaking, within those markets. Now, we can get a little bit more granular, and in my belief, there's probably a 3-tier market in Sydney and there's probably a 2-tier market in Brisbane as an example. So the data will be quite different from each of the different subsets or the areas, so to speak.
A lot of that is going to be demographic based on whether or not you have a job, I would imagine, is part of this confidence equation. And that's the Westpac Melbourne Institute Index. It was up about 12% in October from 93 points in September, which was still pretty strong, up to 105 points. So that's pretty high. That's it's like a 2-year, 3-year highest it's been. Consumer confidence.
Absolutely.
As we sort of emerge out of COVID. And with, let's remember, Melbourne in lockdown is only now starting to emerge.
And that sways the data set from a general point of view. But if you overlay that too with what's known as high search intent or high intent search from the real estate platforms, so to speak, they're higher today than what they were this time last year.
But there's no properties on it because there's no stock on market.
But it's in the intent. It's the people, how many times they're visiting the website.
There, go and check it out and have a look.
Yeah.
So that's an indicator. If people are searching more for property, they're obviously thinking about wealth creation or change of some sort, right?
Yeah, even home ownership.
And home ownership. You never really understand the difference. You can get the data out of the platforms, realestate.com.au, for example, of people searching on investor stock versus, owner-occupied. But there's a lot more owner-occupiers in the market, a lot more first-home buyers in the market, and the demographics have shifted in searching like way back probably 4 years ago, before APRA got its hands in the game. 60% of all sales in Sydney were like investor stock, right? And had to slow it right down. So,
whereas investor finance today is at such a low point compared to new finance for new dwellings or first homeowners. But I think someone told me very many years ago, and I'm talking 20 years ago when I first started, that the market is between your ears. And at the time, I didn't really know what they meant. But as time went on, what he meant was that it'll be whatever you think it'll be. There's always an opportunity somewhere, someplace. And even listening to yourself and Tom Panos.
Where you listen and watch that, do you?
I watch and listen to him, not so much about you, but anyway, it's an RJ. But it's
he's talking about what's making headlines every Thursday. I record at about 12:30 on Facebook Live.
Yeah, and he's a very strong advocate of the industry, and he's immersed into it.
Yeah.
And you've only got to look at his enthusiasm and his rhetoric around it will be whatever you think it'll be. In other words, the market is between your ears. And it's everywhere. The agents that we talk to some of them have been the busiest they've been in 10 years. 10 years.
It's interesting. And to my point around how I create narrative around data, narrative around information, I speak to a number of people, yourself included, Steve. This is always a good catch up for me to help shape my opinion towards property markets. The Facebook Live I do with Tom Panos every Thursday. He's someone else I turn to for what's going on in property. Like when you think of ground truth, there's Tom out there any given Saturday auctioneering, locked up through a period of time, couldn't do it, moved into online auctions, back on the ground now doing, 7, 8, 9 auctions every Saturday. You talking to real estate agents right across the country, I get two very different views in different prisms to the market, which I aggregate and go, okay, what's going on? It's been really interesting with Tom, watching and chatting with him, diarising his narrative as we've gone through COVID-19 from, dire situation when Commonwealth Bank, for example, was predicting 30% worst case reductions in property values. And it's got to be interesting at a point in time, 10, 20 years time, to go back and actually listen to that narrative about what we were chatting about at any given time. And our narrative was generally driven by what was between our ears at any given time. And we'd sort of, stress test ideas against each other and have that discussion. But I've watched him. It's been like a sine wave, right? Like, I don't know how good this is to Jesus good right now to I don't know how good this is to Jesus good right now. And his relationship and the interpretation he's getting through the coaching he does through real estate agents and also speaking with the who's who of the zoo in property, his view, stock and market is tight right now. It continues to be tight, and that's driving and fueling a lot of property markets. But it's also impacting vacancy rates and rental rates. And we've spoken about it for many years, Steve, around be careful where you get your information because it can shape negative decision making. And I think we're seeing a little bit of that right now, aren't we?
I think absolutely we are. And if we were reliant upon some of the mainstream media to get our information from and just believe it without questioning it, you wouldn't do anything ever.
You wouldn't do anything.
Ever though.
You'd stop.
Yeah.
And your good friend, what's his name, Harry Dent's been out there saying, I told you it was going to be 40% reduction Here it is.
Do you know what? He said that last time and the time before that. I'll stop myself.
I don't want to, let's not give a beat up, but he gets a lot of people to his seminars though. Like I think some people chase doomsday projections.
You'll always be, if that's your core person to be negative, well, you're going to be attracted to that. You don't have to be very intelligent to be negative at the end of the day. Yeah, this is an opportunity, we believe, and at the end of the day, as the well-worn analogy, everybody needs a roof over their head. That doesn't change. COVID doesn't come along and everybody says, well, I don't need to have that accommodation anymore. It may shape the trends and the ebbs and flows of price or value, but it's still a necessity. And Tom, who gets to deal with hundreds of people and agents because he trains them, he would be on the coalface of what the market or their perception of the market is doing, just as we do. We deal with over 100 agents on a weekly basis. We have probably 300 offers out at any given time, so we know the pulse and the tempo of the markets. And
the pulse and tempo is key, and the what's making headlines to do with Tom panels. There's not a discussion around that, but we talk about what's making headlines, right? So whatever is in the media is what we talk about any given week. Now, what drives media is typically boom and bust type stuff, right? So it's our job to get behind that and actually have a narrative around why would a story like this be in the media and what does it actually mean? Pull it apart, dissect it and go, it's sometimes largely BS, like it's written by journalists who just need to produce stories and they want to put the most sensationalized stuff out there possible. That's not on our platforms. There's other platforms. So just give us some sense of that market. I want to have a chat to that because a lot of people are confused right now, Steve, and they don't know what to do. And we're going to do that. We'll just go to a break beforehand. Back in a moment.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with my guest today, Steve Waters, Director of the Right Property Group. Two key trends you see in the media right now. We're chatting before the break around what's going on. People are talking about stock on market and how that's impacting prices, negative or positive, and then also vacancy rates. So let's kick off with vacancy rates. Maybe we should go the other way. We're going to start with vacancy rates. You pick up some papers or social media feeds and they'll tell you it's blood on the streets and vacancy rates are rocketing right across Australia. Fact or fiction?
Fiction.
With a capital F?
Yeah, it annoys me because it's that, depending on the strength of the organisation that's perpetuating that story and then other people jumping on that bandwagon could very well shape people's thought process about whether they should or shouldn't do something, sell, buy, rent, move, whatever it may be. If I got all the journalists in a room from all the different organisations and said, okay, here's a story for you to run, which is truth, and that is that there are some areas of every state in Australia that have vacancy rates circa 0.5%, half of 1%.
So no vacancies.
Just about.
Literally. The reason why it's vacant is because someone probably doesn't want you in there.
Yeah. So could you imagine if all media organisations perpetuated that story, that the outcome of that would almost be this whole self-fulfilling prophecy or perpetuating story and therefore market. And conversely, if it's negative, it's pretty much the same thing. So when we, in our data collection, which is, if we talk around vacancy rates, where our team might ring up, let's call it 100 different agents in each area, collectively ask what they manage and how many they have vacant, which is right here, right now, live data, if you will, and saying, well, it's between 0.5% and 1%. People wouldn't believe me, but it's the truth. If on the other side of the ledger, I go and ring up the agents in inner city Sydney and say, well, what's your vacancy rate? It's double digits. So there's a general number, but that's where the danger lies. Everybody needs to be granular.
Yeah, it's markets and depending where you are investing. And if you have invested in locations with huge vacancy rates, it's probably not a good time to be a property investor in those areas right now. But beauty's in the eye of the beholder and where people want to live as well. And, you know, the challenge I have with all this is that, and I chat to people all the time and go, yeah, just ask for a huge discount on your rent, you get it. And most agents go, no, that's not the way it works right now. It's actually a premium. If you want this property, we're marketing at $400. There's 30 other people that want it. Where do you sit? And that happens, right?
It happens. I was telling you the story earlier on about a friend who in a particular area of Sydney was looking for a property to rent. They had to pay $30 a week extra and prepay 6 months in advance to secure the property. Like, where do you see that in the media?
Do people say that's fair? Like, is that okay to do? Like, if you're an investor, obviously most of our listeners
from a commercial point of view, it's totally fair as a landlord.
Yeah.
Nobody, as the potential tenant, nobody's got, I believe, the gun to your head to say you must do this. It's supply and demand working.
So where are those stories?
best.
Where are all these people who can't find houses to live in? Why aren't they on the front page of the Daily Telegraph?
Well, I think we talked about this about a month ago. I feel that there are certain areas of Australia that are very quickly heading towards an accommodation crisis.
Yeah.
And I noticed that Damien from Rewa has said around Perth.
Damien Collins. Yeah, I'm actually going to catch up with him soon.
He used to be on the board of People with me, and he's actually said around Perth that they're heading for an accommodation crisis. And I don't believe they're the only city and state, generally speaking. Sydney has it. Brisbane has it. Adelaide has it.
Yeah.
Melbourne's a little bit behind because of their lack of mobility, but who knows where that will head.
Well, Dame is a quality operator. He's another person I turn to. He's dialed into the Perth market. So a bit of a teaser. I'm going to have that chat with him on the podcast. We're actually going to break down Perth and actually see what's going on. But you're active out in Perth, aren't you?
Yeah, we see it there already. We're part of our diligence, and we've been on the ground in Perth for 2 years. Necessarily, we haven't been buying there for 2 years. It's just part of our ground truth.
The last time, because we've spoken about it a lot, last time you were out there was in March, just as COVID hit.
We got one of the last planes out.
I think you got the last plane out. It's like the last plane out of Vietnam or Khe-Sanh or something like that.
But we've seen vacancy rates tumble over the last couple of years in, we'll call it Perth and its surrounds. I'm not talking about the mining towns or the like. And it's been it's been a quick contraction, if you will. But so too has the other areas throughout Australia. And people are going to wake up eventually and say, wow, we didn't see that coming. Yet it's been happening for the last, I believe, 18 months. In fact, the first stones were thrown or cast 18 months ago.
So as a property investor, considering some of these dynamics around rental vacancies or vacancy rates and anything over 2%, or anything around 2% is a normal market, right? So thereabouts, 2.5.
2.5 to 3% is probably what you'd
deem to be normal.
Yeah, equilibrium.
Transitioned or something or other.
Yeah, 2% is where we're getting tight. And potentially the shift of power, if you will, is going towards landlords, and tenants need to be quick. When you get down to 1%, it's an incredibly tight market. And so when I'm saying that there's markets at 1 and 0.5%,
it's really tight.
It's extremely tight.
So the question I was going to ask you, how do you actually use the vacancy rates today as a metric of whether or not you should be investing in a property in that area? But let's just park that for 1 second. Can you just explain, Steve, the relationship between property prices and vacancy rates? Because they typically move at different stages of the cycle. And let's use western suburbs of Sydney, where you bought a whole bunch of properties for us back in the day. We had huge capital growth over a period of time, but rents went down. But now we're starting to see positive pressure on rents where we can start lifting them again. So can you explain that relationship between price growth and rental growth?
Very rarely will you get that point of equilibrium that lasts for the longest time. It's very much reactive to the market, and that really comes down to pipeline analysis. So if we go back to your scenario with the western suburbs of Sydney way back, when we first purchased those properties for you, they were circa 6 and 7% gross yields, which in residential is extremely high. In Sydney, it's historically high. But as building permits and pipeline and what have you, and they released the land, changed the zoning, more people jumped into the market, more people built, well, then you start to see the contraction in the gross yields because there's more accommodation till it gets to a point where enough is enough, so to speak. Now what we're seeing is because of the lack of I'll come back a step. That's usually around attached dwellings as well, because it's very easy to build up and a lot on a very small footprint of land. But you get to a point where it becomes saturated and starts to lurch or ebb the other way, which is what we're seeing now. So pipeline analysis is very, very important. But where the vacancy rates have a relationship with value is from that commercial aspect of residential real estate. There is always, and always has been, a commercial aspect to residential real estate. And usually once you see that amplified cash flow, so the gross yield, it becomes too attractive for investors in any asset class to walk past. It just becomes, that makes sense. Just as it did when there were 6 and 7% in Sydney, just as it is in today around different parts of the country. So examining the commercial aspect, which is a direct reflection of supply and demand, is ever so important. But as is pipeline analysis, there's no use going to an area that is tight today, but there's 5,000 dwellings in a condensed area coming down the pipeline.
And therein lies challenge of the question around how do you use today's vacancy rates as a metric for investability in a particular location, because they're not static by any means.
No, but there still needs to be that underlying fundamental context within an area. So if we were into a very sub-regional town where we're getting, I don't know, just for math's sake, 10% yield, but it's a subpar regional area and there's 4,000 dwellings in the DA stage, that's going to affect our rentability, therefore our yield, therefore our value, maybe 12, 18 months, 3 years' time.
So it might shape your strategy then to get in there. If you want a good yielding property that generates a bit of cash in your back pocket, that might be a mechanism for equilibrium to your portfolio, but you need there's got to be a reason why you would invest in that sort of location, right?
Well, generally speaking, that would be probably a transient investment for you where you're in and out, trying to pick the bottom and the top of a market, which I don't subscribe to, but that might be your bag, so to speak. Even if you're chasing cash flow, you still need the growth. That's where the wealth component lies. The cash flow is there to control the asset for the longest period of time.
Yeah.
Chasing $5, $10 a week positive cash flow, you're going to need 100 of them to be really worth it.
Yeah, and that's pretty hard work. So that's the vacancy rate. So every markets within streets as well. I would imagine vacancy rates in some of the inner city places are pretty high right now, but there would be locations or buildings which have still pretty good vacancy rates, maybe because there's something unique about them or there's something at all. It doesn't mean a catch-all for everything in that particular area.
No, and that's a good point. And if you took, say, Brisbane as an example, where they have potentially an oversupply of attached dwellings in the CBD and immediate surrounds, plus I think there's about another 4,000 in the pipeline. But you can be in those same suburbs or thereabouts and have a house for rent and it's out the door rented in no time at all, because people want the houses, will always want the houses, and they're not going into the unit no matter how cheap it is.
So would you be buying units in this market? General question. Make you nervous? You wouldn't be buying new stuff.
No. Well, I'm a value investor, no matter what the asset looks like. So if the price was cheap enough and it made absolutely sense, I would.
Fair enough.
It's just about value.
But it's finding the properties is the problem. And let's have a chat about that. We'll go to a break beforehand. Back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Steve Waters, Director of Right Property Group. Stephen, fact or fiction? There's a glut of properties out there right now. Getting one is easy. Investments for units
Correct and incorrect.
houses. Correct and incorrect. Depends.
It
always
depends.
It reminds me of the day on Sky TV when you get a question from some person, they just go, I've been thinking about investing in a townhouse in some location you've never heard about. Or it all comes down to fundamentals.
There's a general disclaimer. Look, I think, there's no secret that the attached dwelling and especially investor stock, there's plenty of to choose from if that's what you're into. But quality attached dwellings in quality areas is still very tight. There's not a lot on the market that makes sense. So that might be, as an example, attractive buildings, small blocks.
Boutique blocks in these
low cost to operate,
for example.
As an example.
Unique type stuff. That
But if houses are still very, very strong, and houses are strong in all states. And the reason for that is because you can't build as many on on same size footprint of land, and zoning's completely different as well. Whether there's been a seismic shift away from attached dwelling because of COVID for the future is yet to be seen. And even if there is, I don't think it's a forever scenario, just a moment in time. Whether that's 1 or 10 years is yet to be seen.
What's going on with those blocks? And you call it probably sub-grade investment stock. It's horrible, but like your Opal Towers. I was out in the Olympic Village just on the weekend for something else, and I looked at it and I went, I wonder what's going on with that. There didn't look like there was many people there.
No, it's actually, it's a good point. I wrote a blog, I don't know, maybe 8 months ago about the ghost towers of Sydney because of the quality of construction was lacking. And it's almost like the perfect storm has eventuated. So you've got low construction quality, subpar materials. Now you've got a crisis as well as oversupply. And I would imagine that you will see those stay empty for a long time. Eventually, I would imagine someone's going to have to tip in quite a lot of money and they're going to be torn down and completely re-engineered, I would imagine.
I looked at the block and I went, it doesn't look that bad. Like, it's not an unattractive block, but...
And the location's okay.
Yeah. So what's happening to all the people that invested in them?
They're out.
They're just gone. It's just a dud asset that they're still having to pay the mortgage on.
Yeah. I don't know how that, whether insurance, and I don't know whether their strata insurance tips in for that. I'm not sure, but it's a horrific outcome for them.
Yeah, and they're in some ways, and it sounds horrible, and this is detached, I'm not talking about the emotional component of it, that they are a statistic of, they're one of the, whatever the 8 in 10 Australians or 8% of Australians who have an investment property, they're probably one of the ones that only ever invest between 1 and 2 properties because their first one is not the right one.
Yeah, and maybe, correct. And maybe a little bit of fortune being that the mortgage moratorium may have kicked in for them at the right time.
Maybe.
Low cost of money, maybe.
It's only a small reprieve for a period of time.
Yeah.
On a
I'm hoping insurance
30-year mortgage,
Yeah, but even if you go out to areas, but it happens in housing developments as well. So if you go out to parts of Western Sydney or a part of Western Sydney.
Well, there's a highly populated, highly profiled
correct
thing right with subsidence because they didn't pack. I think it was an old tip or something out there, wasn't it?
It's an old defence site.
An old defence site. They didn't. Where is that?
It's in Penrith region.
Penrith region, yeah. Yep. So they didn't pack it properly. So these things are falling apart. So some of them worse than others. If you were lucky enough to get a house that was on the original land, you're okay. But if you just go 2 houses down and you're in a subsidence section, you're done, right?
Yeah.
That's a huge issue.
And you wouldn't think so because it's one of the nation's largest developers that you'd think that it would be okay. You're not running with a 2-bit operation there, but
they are remedying it, though, from what I understand, or buying back properties.
So where do they go?
Yeah.
So where does the unfortunate owner that's put their heart and soul into an owner-occupied property, saved maybe for a long time, to say, okay, well, you're now in a property that's uninhabitable, it's dangerous. Where are you going to go? Because in terms of tight markets and vacancy, let me tell you, that region of Sydney is tight.
Tight.
Very tight. I don't know. It's a minefield of litigation, I believe.
So stock on market then is dependent on the area. So the asset class will determine how tightly held vacancy rates are, which are done, but properties themselves. So are you seeing rampant price increases in areas with very little stock on market?
I would, and yes, is the short answer, but we've also seen increase during COVID in areas that potentially their rents have stayed solid. They haven't contracted, but they haven't gone up as well. It's just everybody seems to think, rightly or wrongly so, that area is going to do well, and we've seen the price rise. So there are some parts of, let's call it southwest Sydney, where we've seen 10% growth during COVID. We've seen areas of the central coast of Sydney, the south coast of Sydney.
So what's driving that? So you're probably talking about even down sort of metropolitan areas outside of the CBD. So Wollongong Way,
so Wollongong Way.
Southwest Sydney.
Yep, southwest Sydney, central coast of that Sydney basin, Newcastle, the northern parts of Brisbane have grown extremely well during COVID. Western Australia.
I can see why. I was in Newcastle on Friday, which is a beautiful day, by the way. I could see why people live in Newcastle. Pretty cool. And it's a very diverse, it's a microcosm of Sydney, essentially. All different types of real estate assets.
It is, and that's potentially why Wollongong has done just as well, because it's more,
same but different.
But far more commutable to Sydney should you want to, or should you choose to work there or have to work there, whereas you're not going to work in Sydney and live in Newcastle.
But you'd be on the Central Coast, though.
Yeah, correct. Yeah. And that's that commutable distance as we were talking about before. But there are certain parts throughout the whole of Australia that we've experienced. So this isn't a statistical guesstimate. This is what we are experiencing, that during COVID we've seen up to 10% growth.
And what is the driver of that growth? Low stock on market and demand for those proproperties?
Yeah. Kind of always goes back to that, but
demand, right?
It's around affordability and lifestyle.
Who's buying this stuff?
A mixture of downsizers, first homeowners, and to a degree investors.
So pretty much everyone is out there right now. So, for a period of time, investors are out of the market. First-time buyers come in, downsizers coming out. They're trying to free up some equity to do other things with. They're not going on cruises at the moment, but they're no doubt be cashed up. So you've got greater demand from various classes of
It's a broad
property
spectrum
buyers,
of
a
people
broad
now.
spectrum of people.
So not as in yesteryear where it was all investors or it was all upsizers or downsizers or first time owners. It is a real blended scenario. Now I can think of a place or a couple of suburbs in Brisbane where literally if you talk to, there's two property managers up there that have 3,500 properties under management themselves. They have 5 vacancies. 5. Okay. So what's that? Less than 0.5% vacancy rate over a big data point, if you will. But in that market, anything that is being put up for sale that is vacant or has a home occupier in it is being very quickly purchased by first homeowners because it's cheaper to rent than it is to own. Sorry, it's cheaper to own than it is to rent.
So it's good for both. If you're selling property, it's good. And if you own investment property, it's probably not bad either.
It's a pretty stable market.
Should you be pushing your rates up in Brisbane or areas of southwest Sydney or western Sydney?
Southwest Sydney is not at that point to be able to push rates up or rents. You're talking about rents up of any sort of real consequence. I'd also answer that by saying, look, there's an ethical component here as well. We're not out of COVID, and you don't want to be that person. Yeah. And then there's also some state laws around different areas whether you can or can't with existing tenants. Yeah. But the market will be with the market if the property is vacant.
So a real estate agent's busy at the moment, fact or fiction?
Fact.
Yeah. Why are they so busy? Chasing listings or
that's a good question.
Selling properties?
Bit of both.
Yeah.
At the core of any real estate sales business, I'd imagine, is listings. So they need something to sell, and that's a big component of the business, is persuading someone to list their property to sell with them. So they are doing whatever they are doing to get those listings. And in terms of the selling side of their businesses, they'll have open homes and they're full, even if it's in a staged manner because of COVID.
So they're not banging down your doors at the moment, real estate agents?
It's always been a pretty good indicator of what the market is doing. It's not a scientific fact, but if we're making phone calls, if our team are making phone calls and we're not getting replies, the market's pretty buoyant. Whereas if they're ringing us off their own bat, it's a slow market, and that hasn't happened probably since the election.
So it must be harder for you and your team to find good stock on market now. Like there's a lot of stock on market. If it's crap, you go and buy some, in a high rise, no doubt tomorrow, right? There's probably, where I said I was out in Olympic Park and I was driving around sort of that area back of Olympic Park. Everywhere, like towards back down towards, what do you call it? Where all the old artillery stuff is.
Homebush Bay.
Homebush Bay, where are those, the old storage for ammunition, artillery, something or other. There was literally, I sat there and I drove along and I went, for sale, for sale, for sale, for sale. There was signs, how they chuck it into the nature strip. Yeah. And it was literally the whole nature strip for a kilometre, I reckon, was just for sale, for sale, for sale, for lease, for lease, for lease, for lease, for lease. And I remember I was sitting there going 1, 2, 3, 4, 5. So I reckon in about 100 metres I counted about 30 or 40 of them, right? So there's lots of stock out there.
There's lots of stock out there, and that stock's not too bad either. It's just that the demographic, if that's the way to put it, that is purchased in there may not be wanting to be there anymore. Now, conversely, though, if you go out into, once again, we'll just talk about the Sydney market for a minute. If you go out to the acreage parts of the Sydney market, where traditionally it's the first thing to go down and the last thing to go up, the acreage salesmen have been extremely busy during COVID because of that.
Stock, no doubt.
Well, and they're selling whatever they get because people have had that seismic shift away from the built-up areas and wanting to get a bit of room and space.
I was looking at Windsor today, actually, on a Google map, and I was like, it's a pretty built-up area. There's a lot of greenfield out there still. Like if you go north and even northeast of Windsor, there's a lot of acreage stuff there at the moment.
A lot of it floods.
Is that the issue? But I'm talking even like out towards Pitt Town and even further out towards Wiseman's and even up north of Kellyville and all those areas. There's still a lot of acreage available.
It's been seismic growth through there in the last 5 years. Like unbelievable. Well,
Windsor Road's been I drove that the other day and it's everything it's all getting rezoned into high density.
It's crazy.
It's a huge corridor now.
And that's the beauty of, it's one of the last bastions, if you can find the land there that's not flood affected, that has the capacity to potentially rezone in the future, because Sydney is that market that is geographically constrained. It's a basin, literally. Unlike
good for land banking.
It's great for land banking. It's that example I gave you where it was that the client had to pay an extra $30 a week and prepay 6 months. That was in that region. That was in the Hawkesbury region.
Okay.
So it's enormous to think what's happening.
Yeah. But you see the same dynamics in every capital.
I see it in Brisbane. I see it in Perth. Should you purchase a property there that's vacant? South Australia to a degree. Melbourne, no. ACT, yes. It's literally Northern Territory, yes. Not that we are up there, but it's everywhere.
So good quality investable properties are hard to find in this market. So how do you go about finding them? And you got to remember you're competing against, if you're doing it by yourself, you're competing against guys like you, and we spoke about Damien Collins, who do this for a living. So how do you compete in that market?
Preparation. So that means you're trying to make the offer as least complicated as you can. Don't be tricky.
Yeah.
But nothing will beat the relationship. So be up early, be on the phone, send the text messages, and just be in the face of any agent.
So be responsive.
Everything.
Be aggressive even, because if you find something, don't diddle around with it. Move quickly.
Yeah, but not to the degree of stupidity, and there's a FOMO element there, but it's your price is your price.
But this what pushes prices up, because of this demand fuels price growth.
Which then becomes self-fulfilling and perpetuating. That's
Property
FOMO.
101.
Absolutely.
It's cool. Interesting market.
It's a fantastic
Are
market.
you enjoying buying property at the moment, or is it pretty hard?
I love markets that are in flux, or on the surface that are in flux. And it goes back to the GFC for me was fantastic. Just after the GFC was fantastic.
Yeah. You think about, mate, go back to those prices, though. You're probably $200,000 in Sydney, right? $250,000 you'd be.
It was, we stopped purchasing in Sydney probably, I think it was about 2014, 15, because the numbers just didn't work for us then. And the market still perpetuated.
Yeah.
But we'd been there, done that, and we knew that they'd contract because you can't have that sort of element of growth. And we deployed elsewhere. And it's only been literally since the election or thereabouts last year that that we've been able to make the numbers to work, and a few other areas throughout Australia. So for us, this is just our moment in the sun, and we go as hard as we can to control what we can.
It's good times, and I guess therein lies the secret. Don't be buying properties where everyone else is buying at the moment. You need to be finding those locations which are going to be the areas that everyone's buying in 2 and 3 years' time, right?
That's the secret.
And that's where you're not going to give me any information around that, are you? Everyone's going, tell us.
I'm an
Just
open
tell
book.
us.
I'm an open book. Asking you, I'll do my best.
Give me a suburb, Sydney,
You asked
Brisbane,
me this probably
and
about
Melbourne.
3 months ago when we did this last chat in June. You asked me that exact same question. What's my pick in Sydney? And I said, for you, Phil, and just for you, the Golden Triangle, 7 Hills, Layla Park, Marion, go back to those prices then and see what they are today.
I bought.
Yes, you
in
did.
7 Hills in October, I think, of last year.
Last year.
Maybe.
Yeah.
What do you reckon that's done? I reckon that's done well.
Absolutely.
Golden Triangle.
Absolutely. It's done, I'm going to say, easy 10%.
Wow. You made me feel wealthy.
Yeah.
I've just made.
That's why you pay me the big bucks, right?
Yeah. Can't remember what I paid. 725, maybe? 725? 770. I can't remember the number.
Yeah, you've got quite a good block though as well.
Yeah. Good asset. Yeah. I'm ready to buy again. We'll do it. We're ready to buy again. Smart Property Investment. We'll have to get you back for a portfolio update, Steve.
Sounds good.
We need to go again. Got to do some stuff. I like the market right now, but like everyone else, it's just getting in there, finding the right stuff at the right time. And strategically, what do you get? You're looking for sort of renovation stock, manufacturing equity stock.
Depends.
Buy and hold stock.
It's the key to it though is the preparation because and we're having a meeting with our team this morning, and when we put in our offers and we try to make the terms to suit us as purchasers, so that might be extended cooling off, pest and building finance clauses and the like. The rhetoric back from our buyers agents now is can't do that. We can't be tricky. We can't blow out our...
So if it's good, get it, control it, move quickly.
Yeah, because there's so much demand there that if we ask for bigger pest and building finance clauses or cool-offs, the agent's just going to the less complicated purchaser who's just as black and white, straight up and down.
So there's no such thing as distressed stock in this market?
Subpar there is.
Yeah.
But not for the good quality stuff.
Okay. So you're going to have to compromise. Might be a termite pit, for example.
I just bought one of them.
Yeah.
Not that everybody should, different.
No. But there's going to be compromise. You're not going to find someone who's bleeding money that needs to sell their property tomorrow at a low price.
Very rarely.
Get out of jail.
No, very rarely. So value is not, don't get too caught up in what the asking price is because value is in the eye of the beholder. It's more about does this opportunity suit you and your portfolio or your first property, wherever you are, and execute from there.
How are valuations stacking up from banks?
That's a really good question. Valuers are still a little bit ginger at the moment.
Ginger being a property term for...
I just made it
A
up.
bit shy. I know what ginger means. He's a bit ginger, but some people might go, what does that mean?
It's in the glossary of terms. No, they're a bit shy, especially in an area that is perpetuated.
It always lags anyway, but
It does, because they have an enormous risk upon their shoulders when it comes to valuations, and they don't get a lot of time to do a lot of diligence no matter what they say. In a market that's moving quickly, but with all this peripheral sort of negativity around, the sales agent might achieve a really good price, but in some cases we've seen the value, not for our clients, but just generally speaking to the agents, where the value goes, I don't know about that. It's 5% less or thereabouts. But that's only, I don't know, maybe 3, 4, 5% of the time.
yeah. Lots of info there. People are probably sitting there going, I don't know what to do. But anyway, keep listening to the Smart Property Investment Show. It's where we give reason to the madness. It is a good time to be in property if you are buying well and you can buy. And, again, there is parts of the market who are hurting right now. There is a lot of Australians without jobs, highest unemployment in our lifetime. There is right now. So our thoughts are out there to those people who are navigating what is challenging times, small business owners who have been hit hard with quality businesses who have been set back for no fault of their own, lockdowns, etc. Good news is that it will return to some period of normal. You just got to weather the storm during that period of time, particularly our friends and colleagues down in Melbourne who look like they're going to be coming out of lockdown soon. So that's a good thing for those people to get back running, moving forward. Fortunately, money's cheap at the moment if you get your hands on it. That's the secret.
If you can get your hands on it.
Yeah, if you can get your hands on it. Anyway, Steve, good mate. I enjoy the chat. Thank you for
lovely
that.
to be back.
Let's portfolio update soon. There's something I want to chat to you about, and you're well across it, and that is a renovation, a forced renovation that we currently have in Brisbane.
I think it's the world's longest.
Yeah, I'd go, what's going on with that? Anyway, we won't ruin it, but I've got to sort it out.
Yeah, we'll be right back after this break.
Mate. We'll be right back after this. Look out for it. It's a really good story, and if you ever wanted to question whether or not I only tell the good stories when it comes to our portfolio, I think you'll find that that's not the case. This has been
absolutely
a bit of a cluster F, etc. No fault other than my own, by the way. But anyway, I'll share that story and I'll get Steve to come and help me with that because he's helping me navigate it. That should probably have that over the next couple of weeks or so. Thanks for tuning in today, everyone. That's what we're talking about. There's portfolio update, which we cover off. We look at the Smart Property Investment portfolio, which has 18 odd properties in it. More focus of that coming forward. I've got a whole bunch of new numbers for smartpropertyinvestment.com.au for that. Watch this space. I'll let you know when it happens. Probably align with the next podcast I do on that. Please keep those reviews coming on iTunes or whatever podcast platform you listen to this on. The guys and girls here get a real kick out of it, knowing that we are making a difference to your property buying journey. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are you in the real estate industry? We're on the lookout for Australia's best agents, networks and property managers to enter the REV Awards 2021 with principal partner ListReady. The awards provide an invaluable opportunity to showcase your contribution to the industry, raise your profile on the national stage and celebrate your achievements with your peers. Nominations close in November. Start your nomination now at realestatebusinessawards.com.au/REV-awards.